Is the government raising our taxes through mortgages and not telling us about it? Hear me out. I think you'll be very surprised by the end of this video. Hello, and thank you for listening. I truly appreciate it. Thank you so much, because I do know that time is precious, and the fact that you take time to watch me means a whole lot. Thank you so much. Now, on to my huge accusation about taxes and the government. But first, to me, the problem with government, and mainly politicians, is that many of them have never accomplished much, but they consider themselves to always be the answer. Right? Many of them have never ran a business, never felt what it takes to make a payroll or to miss a payroll, to ensure a profitable organization. Yet, those are the ones, the politicians, they're the ones who set the laws. To me, that does sound a little narcissistic, having never done what we're doing as business owners, yet telling us how to do it better or how to do it right. Thanks for your advice, Alexandria Ocasio-Cortez. I think it's cute, but I'll pass. What's worse is when the government makes changes to our industry, but it doesn't respect us enough to explain the reasons. Sure, they'll put out a headline, of course, right? But they don't take questions. That's how much they think of us. Either we're too dumb to understand, or they cannot tell us the truth as to why they're making the change, because we'd be pissed. And here we go, all over again. We're pissed. It was announced that the Biden administration decided that they are changing the way they do mortgages. They are now finding a way to raise your taxes through mortgages, but instead of saying that, they are repackaging it as, quote, their mission of facilitating equitable and sustainable access to home ownership, unquote. That's from the director of FHFA, Sandra Thompson. Remember that word, equitable, okay? Now, I know what you guys are thinking. Fannie Mae and Freddie Mac can't raise our taxes. They are a private entity. Well, as of 2008, the government agency FHFA took over conservatorship. What is conservatorship? A conservatorship is a form of legal authority held by one person over the property of another. Basically, Fannie and Freddie answer to the FHFA. FHFA is the mommy and daddy making the decisions for the Fannie and Freddie family. Now, there are 3 ways that they're taxing us through our mortgage, and I'll explain why I consider it a tax at the end of this video. Let me first, before I talk about the 3 ways, let me show you an article that I read. It says Biden rule will redistribute high-risk loan costs to homeowners with good credit. All right, article goes on to say a Biden administration rule is set to take effect that will force good credit home buyers to pay more for their mortgages to subsidize loans to higher risk borrowers. Again, let me tell you, this is a lie. It's a huge lie, because they're talking about subsidizing loans. Well, I'm going to prove to you how all they do is collect and they never redistribute. It says experts believe that borrowers with a credit score of about 680 would pay around $40 more per month a $400,000 mortgage under rules from the Federal Housing Finance Agency that go into effect May 1st. Costs that will help subsidize people with lower credit ratings also looking for a mortgage, according to the Washington Times. Again, subsidize. They keep talking about this word subsidize. I'm going to prove to you they're not subsidizing anything. Here's loan officer talking about how this doesn't make sense. This says the Federal Housing Agency, which oversees federally backed home mortgage companies, Fannie and Freddie, has long sought to give consumers more affordable housing options, but those who work in the industry believe that the new rules will only serve to frustrate and confuse people. I promise you that, because it doesn't make any sense. Then it goes, quote, this confusing approach won't work, and more importantly, couldn't come at a worse time for an industry struggling to get back on its feet after the past 12 months, unquote. This is from David Stevens, a former commissioner of the Federal Housing Administration during the Obama administration. And he went on to write that to do this at the onset of the spring market is almost offensive to the market, consumers, and lenders. Couldn't agree with this guy more, Stevens. I'm going to go ahead and scroll down. You guys want to read the article, you can find it on Yahoo News. But right here it says, this is a quote from Stevens again. Quote, why was this done? The answer is simple. It was to try to narrow the gap to access to credit, especially for minority homebuyers who often have lower down payments and lower credit scores, unquote, says Stevens. So again, he doesn't agree with it. He's saying that that's the reason why they're doing it, but that's not. That's not the reason, and I will prove it. Now, let me explain to you that there are three ways that the government is raising our rates. Raising our taxes, I would say, hiding it. You already heard in the article where because of the fee, or because the average is about $40 on a, what was it, a $300,000 mortgage or a $400,000 mortgage? It was $40 on a $400,000 mortgage. $40 more that Fannie and Freddie are collecting. And when I say government, I mean Fannie and Freddie, but who owns Fannie and Freddie? The government. So if I use those words incorrectly, that's what I mean. The three ways that they're penalizing us is A, you're getting penalized for a higher down payment. That's right. What used to be considered a positive, less risky behavior is now going to be penalized. Okay. 2, credit scores. Again, the higher credit score doesn't get the best pricing. What in the heck does that mean? And 3, debt to income. Where there used to be no fee, they've now added on a fee. Now they're saying that they're trying to subsidize people and help them. And I'm going to prove that they're doing the exact opposite of doing that. Now, listen, this is a big point here. Just because you have a high credit score doesn't mean that you make a lot of money. What it means is that you're very responsible in what has been given to you in the form of debt. So, which means you've taken out debt and you've paid back debt. And creditors love that. That's all it means. You could still not make that much money, and these rules would hurt you tremendously. And let me explain more. On to the charts. So I said that there are three ways that they're hurting you: down payment, credit scores, and debt to income. So let's talk about first down payment. This is what they call the new and old LLPAs. LLPAs are loan pricing adjustments. So what that means is, let me make sense of that real quick. Essentially, everything in mortgage is based off of risk, right? Just like insurance. Meaning, if you get into a car accident, you're considered a little bit more high risk. So your premium is going to jump up once your policy renews. Also, if you decide to go to another insurance company, your premium will still be a lot higher because it's going to show that you've gotten into a wreck, meaning they're going to assume you're a little bit more high risk. That's just how money works. That's just how, business capitalism works. If you're high risk in mortgage, you're going to get a higher interest rate. If you're low risk in mortgage, you're going to get a lower interest rate. And parts of making you lower risk is by putting a bigger down payment. All right. So if you put 20% down, you got more skin in the game, right? You got a lot more to lose than somebody who puts nothing down, right? No down payment. So as of last month, you'd get a lower interest rate by putting more down. But, government says that that's not right. They want to do it backwards. So now you put less down, you're going to get a better or a less of a hit or a credit to what they call your loan pricing adjustments, LLP, loan level pricing adjustments, LLPA. So let's go back to this chart. So if you look at the chart over here is credit scores. And this at the very top, this top bar right below this line is LTV, loan to value. Okay. So basically what they're saying is if you are in the yellow in the middle, there's no change. There's like roughly no change, right? But if you're in the red, huge change to the bad. If you're in the green, good change to the good. Common sense. Well, first let's talk about down payments. This stuff up here at the top. As you see, if you put 15% down in this little bracket right here, you're going to get hit up to I should have actually went down further, but you're going to get hit -0.75 or -0.75 basis points. So that means it's going to cost you that much more in your interest rate. Now, interest rates cost money. Okay. And sometimes you get a higher interest rate, so it doesn't cost you money. Sometimes you pay money so you can get a lower interest rate. In this scenario, they're saying it's going to cost you negative 0.75% if you put 15% down. That's ludicrous. It's a hit. The government is asking you to have a higher size loan amount. They're saying that they're doing it so that people. Well, I'll explain why they're saying that in a second. So, but over here, if you take a look at the corner, these guys get the biggest credit. These guys with the lowest credit scores. Now they get a credit, and then let's go up here. That's 0.25 credit, right? 0.25 credit. If you come over here, that's negative 0.75. So what that means is that's 1 full basis point difference. That is absolutely ridiculous. That they're first you're getting a credit for less down payment, you're getting a hit for a larger down payment, and then let me show you something else here in this chart. Erase all this. Whoops. So if you take a look at this credit score, 700, right? You get a credit of 0.65%. But if you have a higher credit score, all the way up to 779, you get a less of a credit hit. So you would get a lesser of a credit for your LLPA if you had a higher credit score than if you have a 700 credit score. So if you make less money, but you have a super high credit score because you've earned it, you're not going to get help for this, which makes no sense. And if someone could explain that to me, I'm all ears because I've researched this for hours upon hours. So the first way they're hitting us is with the down payments. You're getting a hit for down payment. And the second way here, credit scores, you're going to get hit with a higher or less of a credit depending on your credit score. And the third way that they're getting us is debt to income. Let's see if I can make sense of this. Debt to income. Okay, so this is a chart of the LLPAs. This is, I think, page 4. But if you look down here, debt to income, anything above 40% debt to income. So let me try and explain debt to income. So essentially, what debt to income is let's say you make $10,000. As long as your debt to income or DTI is not above 50% or above, you qualify for that portion. Like there's multiple ways to qualify or unqualify for a loan. One of them is debt to income. They're looking for you on a conventional loan to have generally less than 49.99% debt to income. And what that means is you take everything on your credit report, you take your would-be mortgage, you add it together, and as long in this scenario is not higher than $4,999, you could qualify with debt to income ratios. That doesn't mean you qualify as a whole, but you pass that. Now, what they're doing now is they're saying that debt to income ratio, if once it's above 40%, they're going to give you another hit. I'm calling it another tax. Okay? And why are they, and what do I mean by that? Before, it didn't matter. It didn't matter if you had 28% debt to income or 49% debt to income. There was no hits. But the government is saying, now there's going to be some hits. Now we're going to charge you more, right? Again, it's going to cost you into getting you a higher interest rate. Again, I failed to see where FHFA is helping us in any scenario. All right? And now let me actually go back to why I think this is a tax now. Hopefully this will make sense here. All right. This is the big claim that I'm making. The big claim that I'm making is first they're saying that they're taking this money right here that they're charging people that they normally wouldn't have charged, right? There was no extra fee. They're taking this money and they're redistributing it over here and over here. All this green stuff, right, is being redistributed. And what I'm saying is this money will never be redistributed. Never. Not in any scenario would that money be redistributed. And I'm going to show you based off of a credit score of 660. I'm not even taking it to the lowest credit score. I'll do 660 to 680 credit score and show you exactly what I mean. So this is pricing for a bank, okay? Now, I work with over 20 banks. Um, Most banks are essentially roughly the same, but let me explain that this is not, this is just a scenario. Okay. So this is very much ballpark. And in this ballpark, this scenario, we're talking about a conventional purchase, 5% down, right? Because remember, you put less down, you get a better, you get less of a hit. You get actually a credit. $380,000 purchase price, 5% down. So that's the loan amount, 660 credit score. All right. So now we come down. These are the LLPAs that we're talking about. And then over here, you got the interest rate on this column, mortgage payment, mortgage insurance, that's included. And then you got how many points it will cost to get this interest rate, right? And this dollar amount is based off of a loan amount of 361. So if I scroll down, you see all this is in red. That means it's a cost to the borrower. So at 660 credit score, listen, this is how bad they don't want you to take this loan. This bank won't even offer you a rate. This bank won't even offer you a rate higher than 6.99. They're saying we don't want conventional loans, and almost every single bank is doing this. Some banks might say, all right, we'll let you have 7.125, 7.25, but that's as far as it goes. Nobody is offering rates at 660. Okay, so what they're saying is at 660 credit score, your interest rate would be 6.875 at a cost of 2 points, equaling a dollar amount of $7,800. So for this loan, it's going to cost you $7,800. And you're like, well, wait a minute. They said that they're going to give us a credit. They're lying. The LLPs are considered in here, are taken into account. It's May 1st. So it's considered taken into account. And the reason why I say no one will ever take this loan, because why would you get 6.875 at a cost of $7,800 when you can take the same exact loan, take it FHA. So let's change it from conventional to FHA. Hit continue. Same exact loan. Let's scroll down. 6.875. Whoops. 6.875. $80. And it'll cost you now $80 to get the same exact rate going FHA. Okay? That is absolutely amazing. So let's take this into account one more time. At 6.875, there is an $80 cost going FHA. And at going conventional, same thing. All we're doing is changing programs. Conventional conforming, Fannie Mae and Freddie Mac price out the same. Why? Because it's owned by the same person. So they don't do any pricing. Again, now it's $7,800. Are you going to pay $7,800 when you don't have to? And that's $7,800 for just the rate. You still got down payment. You still have closing costs, etc. Now, this is why I'm saying if we go back to the chart here, that's proof that this money will never be redistributed. They're only going to collect because people are still going to put 15% down because they just don't want the higher mortgage payment. So they're putting money down. So only collecting, never redistributing, right? There is no equitable money being given. There's no equality here. It's just taking. And if they're just taking, to me, that sounds like a tax. Because listen, there's no way they're going to raise fees, Fannie and Freddie, and then take record-breaking, profits because of these fees. It's not good politics. So that money is going to be distributed somewhere, right? Where's it going to go? Back to FHFA. And what's FHFA going to do with it? They're going to probably spend it on some government stuff, meaning it's a tax. It's a one-way street, right? It's never going to be redistributed. But here's the kicker. Here's how now the government is monopolizing everything. Because remember, Fannie and Freddie were they were privatized prior to 2008, right? So they're still the private organization just being ran by the government. But the government is almost putting them out of business. Why? Because if you say, hey, first of all, let me back up. If you had a credit score of 699 or lower, you typically went FHA. Okay. But if you had a credit score of 700 or higher, typically you go conventional, right? Now, because of the way that they're adding onto these hits, what they're doing is they're saying now at 740 and sometimes 760 credit score, it still makes more sense to go FHA. How convenient. And who owns FHA? The government solely. No other private entities. There's no one you got to share the money with, like Fannie and Freddie. You don't got to keep it profitable in that manner in sharing profits. The government owns FHA. So they're forcing people to go from conventional to FHA, and they're saying they're doing it in order to help people. How in the world are you helping someone by charging them more? And they're basically making it a monopoly where almost probably 80% of mortgages are now going to go to FHA because it just makes more sense. There's a less down payment, less hit LLPAs. No way in the world at a 660 credit score or even at a 700 nowadays or 720, 740 in some cases even 760 because of the new debt to income LLPA. In some of those cases, they're still going to go FHA when that was never the case before. Okay, I think I'm rambling now. I think you guys got the point of what I'm trying to say. There's no redistribution of wealth here. There's only taking money from people who make money and then forcing everyone else to go FHA. All right. There you go. There you have it. Hopefully that this made sense. If you guys disagree with me and you see something better, please call me. Let's talk about it because this makes zero sense. I've spent hours upon hours. I've tried to listen to the government's side of things. FHFA, the lady who runs this department, nothing. Not a peep. All it is a statement. All right? To me, this is ridiculous. This is obviously robbing us, but it is what it is, right? And that's why I put this video out so that we can get more educated and know what's happening. Alrighty, now I am rambling. I'll call it a video. Thank you very much for listening. If you stuck to the end, I really appreciate it. Hopefully this was eye-opening. Thank you again, and remember, life is not meant to be, it's meant to create. Too strong.